Coming up on Market to Market, as farmers bring in bountiful harvest, they continue to face supply, policy, and weather roadblocks. Darin Newsom, Ted Seifried, Naomi Blohm, and Roose break down the numbers next.
Pioneer Hybrid International is a proud sponsor of Market to Market. Tomorrow. For over 100 years, we've worked to help our customers be ready for tomorrow. Trust in tomorrow. Information is available from a Grinnell Mutual agent today.
AccuSteel, offering fabric-covered buildings specifically designed for the cattle industry since 2001. The next generation of cattle buildings. Information at accusteel.com.
This is the Friday, September 28 edition of Market to Market, the weekly journal of rural America.
Hello, I'm Delaney Howell. In the past month, producers in rural America have taken delivery on two of the most influential government reports, the WASDE and quarterly grain stocks. The crucial decisions that farmers will make over the next few months have the added pressure of political decisions that are beyond their control. With this in mind, we are going to deviate from our regular format and concentrate solely on the commodity markets. For the week, December wheat lost 13 cents, while the nearby corn contract fought against report numbers to finish flat. USDA quarterly stocks came in above private estimates and erased early week gains as November soybean contract lost 2 cents. The December soybean meal contract added 10 cents per ton. December cotton shrank to $2.76 per hundredweight. Over in the dairy parlor, October Class 3 milk futures fell 25 cents. The livestock market finished in positive territory as the December cattle contract put on 40 cents, November feeders added a quarter, and the December lean hog contract moved 53 cents higher. In the currency markets, the U.S. dollar index bumped up 95 ticks. Crude oil continued its run, adding $2.47 per barrel. COMEX gold dropped $5.10 per ounce, and the Goldman Sachs Commodity Index gained nearly 13 points to settle at 486.20. It is against this background that we've assembled a panel of experts to talk about the future. Joining me for this discussion is Darin Newsom, an independent market analyst, Ted Seifried with the Zahner Group, Roose of U.S. Commodities, and Naomi Blohm from Stewart Peterson. Welcome, everyone.
Thank you.
Thank you.
We had a report come out this week, obviously, with the quarterly grain stocks report. Naomi, I want to kick it off to you first. What were your overall reactions from this report?
Well, again, the government said we have large supplies, and that just continues to be the theme right now with the marketplace. Not only large supplies in the field, but large ending stocks out there in the countryside. So because of that news today, it wasn't just that extra little lift that we needed to get prices to get through resistance levels on daily charts. So prices, unfortunately, tumbled back down, and we're likely to test some short-term support levels in the coming few days.
Ted, I know you were also trading the report today. What are your thoughts from today's report?
Well, yeah, a lot of what Naomi said was true. We had corn, wheat, and soybeans all nestled up against key resistance areas, and we needed a positive report to get through them. We didn't get that, so now we pulled back. You have a new recent high in corn in the overnight session early this morning, and then closing below the previous day's low, so an outside reversal down day. That's not what you like to see on a chart if you're hoping for higher prices. So it looks like we are going to go test that support. I did have a downside target in Dees corn at 355. We went and hit that today, but it looks like we will probably try to follow through early next week and see where we go from there.
I want to get back to some of those reports and kind of the long-term effects that you may or may not see from those, but I want to start here with a social media question that we got for wheat specifically, and I think it's going to garner an interesting discussion. So we've got Louise in Amy, Kansas, would like to know, when is Russia going to quit exporting wheat? Darin, you're our top wheat guy. I'll kick it off to you first.
They're not.
They're not.
No. Russia's going to keep shipping wheat as long as they can. They have no reason to stop shipping wheat. So yeah, I don't look for Russia to slow its exports down at all anytime in the near future. So I would look for that to continue to pressure the U.S. market. And just tying it back to what was already discussed, we can look at the first quarter demand for U.S. wheat was abysmal. I mean, is terrible. 700 and some odd million bushel for first quarter demand. No surprise, but certainly isn't a step in the direction saying, look, yeah, everyone's clamoring to the door of U.S. to try to buy U.S. wheat. It's not happening. Russia's going to keep putting pressure on the market.
Ted, you sounded like you wanted to interject there as well.
Yeah, no, I agree with Darin. This time.
Shock.
Yeah, right. Well, but here's the thing. Russia over the last couple of years has wanted to keep their ending stocks very close to 10 million metric tons. Well, a couple months ago, based on the production numbers, they were going to drop down to maybe sub 4 million metric tons. That's when we were worried that Russia was going to step in and limit their wheat exports. But the USDA has since raised their production based on good harvest results and a very good conditions for their spring wheat crop. And they're back up to just shy of 7 million metric tons. So that's a lot more comfortable for them. Given the current conditions, I don't see them limiting their wheat exports in the near future.
And very recently, though, things have slowed down just a smidge with the Russian ruble starting to rally. And there's been some quality issues there. So we've seen a little bit of a slowdown. But they're going to just keep going as much as they can. A lot of their budget relies on it for the government.
Don?
I've got a little bit different view at it.
Okay.
I think when you look at the world stocks, we're actually down about 500 million bushels on wheat versus a year ago. We're down about 1.3 billion on corn from a year ago. We're up about 50 cents off of last year's price, right where we're at right now. And I think the Russia's exported about 50% of their wheat so far. And I think it's just a matter of time. So I think
a matter of time before.
A matter of time before they quit exporting, slow down their exports. Where there's smoke, there's fire. There's been rumors that they're going to slow down. So I don't think I'd get real bearish on wheat down at these levels.
But let's look at it this way, Don. USDA has no idea what the U.S. produces at any one time. So they really don't know what Russia is going to produce. They don't know what U.S. stocks are. So I seriously doubt if they know what Russia's stocks are. They can release a number. If we look at what the market's saying between basis and future spreads, the forward curve, the nearby contract, the futures contracts rallied 40, 50 cents, but the spreads haven't gotten that much better. They're still weak. We still have an extremely bearish supply and demand situation in wheat. It's probably only going to get more bearish next year. I don't know, again, maybe Russia puts an end to their export program. I just don't see it. The market's not saying this thing's going to get bullish anytime soon.
Well, I do agree with you, Don. Where there is smoke, there is fire. But I don't think we're there yet. I think we might be a year or two removed from that. I do think, I'm sorry to disagree with you, Darin, but I think the wheat...
Now we're back to normal.
There we go, right? But I do think the wheat scenario is getting better on a global scale because, if you take China out of the equation, the rest of the world's wheat stocks are declining and they are continuing to decline. But I think with the oversupply that we have right now, it's going to take a year or two before we get to a point where we really can get excited about wheat. We could really use some more supply chain issues. Australia's had some problems, but everywhere else that we thought were major problems have been better than expected.
Guys, I'm going to interject here. We can continue this wheat discussion in Market Plus, but I want to move on to corn. Today's report. Are there long-term effects from today's report when you look at corn specifically?
Yeah, absolutely. We saw a bump in ending stocks again. That's going to carry over into the October USDA report. And so, in my opinion, demand has been phenomenal. Our stocks-to-use ratio is still tighter, but we have a situation now where corn ending stocks, which used to be the friendliest story in the whole commodity complex, is now becoming sufficient. We've got really big yields out there. And going forward with the soybean debacle, we're going to likely see more acres devoted to corn next year. So even that bullish story that we had been arguing that, hey, this is going to lift prices, has now had the wind just sucked out of its sails.
What bullish story were we arguing?
It was that the global carryout levels had come down and that the stocks-to-use ratio was the tightest that it had been.
I guess maybe I just hadn't been arguing that because we were still looking for over 2 billion bushels. And as you pointed out, ending stocks-to-use are still over 14%. They're just down slightly from last year's 15%. That's still not bullish. Spreads are still showing a 60-70% full commercial carry. Basis is still weaker than normal. There's nothing in there that's a bullish story saying this demand has been so incredible that we've gotten ourselves out of this oversupply situation. It never did exist.
Well, right, because we didn't have a weather story this summer.
Yeah,
well, we did have a weather story this summer. We had Argentina.
Argentina weather story.
Right.
That was the only weather story we had.
Not here.
So we do have one of the lowest stocks-to-use ratios that we've seen in the last 5 years. We had it took the second largest corn crop that we've ever seen with a record yield by a long shot on 90 million acres in order to stop the new crop carryover from declining more than 3 million metric tons, or 3 million bushels.
Isn't the 14.5% that this one came in at, isn't that the second largest on record compared to last year's 15.2?
Yeah.
So all we are is down from last year's ending stocks to use.
Yeah.
We're still above all the previous 5 years when we had record production.
But if you look at it year on year, we're still down.
We're down from last year.
And a lot. We're down 1.3 billion bushels, you know, even after this one. So, I mean, I don't know. I've just got a different view. I think a person just has to be really careful. We're just coming. I think what we're trying to do is move the export pace back to the United States. You know, if you look at the United States, it's going to export about 2.4 billion bushels of corn. You got Brazil and Argentina right at 1 billion each of those. Ukraine. All those places had somewhat of a problem. You know, we had a dry drought situation in Brazil, Argentina. Argentina is going to be sold out of corn by the time we hit mid-November. So I think we're going to have a chance to see the export pace pick up. And I think that's, if you look at it this last week, we had the 3rd highest export on record on corn. So I think that's the job of the market, whether it happens or not, but it's to move the export pace back to the United States, not only on corn, but on wheat also.
And how much of the higher stocks number that we saw, or higher old crop ending stocks, how much of that is exports that the USDA had on sales that we just ran out of time to get shipped in that time frame?
That's a good point.
So is that exports, are those export sales going to be added to the exports for new crops? So are we going to absorb a good portion of that 138 million bushels that we saw above our expectations, or above the USDA's expectations on this quarterly grain stocks report?
Yeah, you know, and if you look at that report, actually, you know, the export pace has been strong. It was the feed usage in the last quarter that was down about 90 million. And that's somewhat hard to believe with record
I would agree with that.
livestock supply. So,
Absolutely.
you know, that'll be a question mark going forward.
The other thing I want to make sure we get in here with corn is we rallied 20 cents from the recent low. Today we had a reversal day. Where do we go from here?
I would say in the short term, meaning for the next month, we see prices just continue to trade in the pattern that we've been in, where 350 is support for December futures, 370 would be the resistance point until we can see the basis levels start to improve, and that's not going to happen until we start moving this product and using it more. Boy, wouldn't it be great if we could see ethanol and the E15.
Hopefully something comes out
right?
from
That'd
the
be
Trump
great.
administration.
Absolutely.
Yeah.
That would be something that would help the market move. But going forward, we don't have a reason to have the discussion of extremely high corn prices. We just don't have that at all, because we've got too much supply out there, and just even though demand is great, the supply is plentiful.
So are we going to touch recent lows and put in a new low, or have we put in a new low?
You know, the thing that we have in the corn market actually is very similar to what we have in the soybeans. We have big supplies where, you know, we can't really go up, we can't really go down. We have the big carry in the corn, 25 cents. So December corn has huge support at 340 to 350. You know, we're 355, almost where we were a year ago. But then when you look at July, because of the carry, you get up to $3.95, $4, $4.05. You're running into the upside target. So until you can shake that loose, and then when you look at 2019, when you get over $4, if you're going to add, 4 million acres next year, you're anchored there. So it's a range-bound market to me.
Darin, I see you chuckling there.
Yeah, well, there's some, chuckle all the time. But yeah, what we can really hope for is that it breaks down through the support. You know, I still like the long-term downtrend. You know, the fact that we've made new lows, you know, if we look at the monthly charts, we've made new lows recently. I like that. Tells me that we can continue to go down. Don't see anything that disproves that either in basis or spreads, as Don was just talking about. You look at the carry out to the July. There's absolutely no reason to think that this thing's all of a sudden just going to turn around and go screaming higher. As Naomi said, you know, there's no reason to make the ultra bullish argument. Yeah, we could be range bound. I hope we break out of that range and continue to grind lower right now.
Well, how can we do that with crude oil prices being as high as they are?
Because there's no connection. There's no connection. I mean, there's no connection at all. Crude oil has its own set of fundamentals. Corn has its own set of fundamentals. Gold has its set of fundamentals. I mean, you might as well say, I don't know, I can't even make up a combination, but there's no connection. I mean, I've heard all the arguments over the years that crude and corn have to trade together. They don't. They don't. We can see crude oil go up, and all that means is you've got the investment money thinking that the supply and demand situation is much more bullish in crude oil than it is in corn. And if that's the case, they're going to put their money in crude oil.
Okay. Well, I think that we're going to see, as long as the crude oil price can stay firmer, I really think that the correlation is there in terms of ethanol and the corn demand.
Ethanol.
Guys, I'm going to put a pause on this. We're going to continue this in Market Plus, but I want to make sure we get this social media question here as we look at planning for the coming seasons. Vance in Nebraska says, with higher stocks, is it best to price more of the 2019 crop earlier in the market year than usual, using historical patterns of highs coming in early summer? Anyone want to start, Don?
I think when you look at the market, if we are going to add acres, like it looks like we could next year, 3 to 4 million acres, you probably going to have to set targets a little bit lower than you have the last few years, and you're probably better off to be a little bit earlier.
How much lower are you thinking?
Well, right now already, just because of the carries, you're at $4 basically, and I think when you're between that $4.10 and $4.20, that's probably a good target if you can do it sooner rather than later, and then buy yourself some insurance in case you have some weather problems. This will be the 7th year in a row that we haven't had a weather problem, and I mean we're overdue, so that's your big concern.
What about soybeans? I mean, there's so much uncertainty right now. Would you be marketing those ahead of time?
Well, I mean, very similar to what Don was saying for corn. I mean, yes, you want to be looking for your opportunities to sell soy more than anything else, because that's the one that we're really worried about. Hey, listen, if we get to January, February timeframe, and we don't have a deal in place and South American crops looking really good, that's when things could really get ugly for soybeans. So, if we get a window of opportunity to sell something here between now and the end of the calendar year, we want to do that. But then having something for the upside potential, in case there's a weather issue with South America or us, in case there's a deal put in place where China says, hey, we're going to buy this amount extra soybeans from you, you want to keep that upside potential. Soybeans is a market you always want to keep upside potential in, but you got to be really careful about trying to make those sales, and I think you want to be targeting some of that, a good portion of that, between now and the end of the calendar year.
Ted, what strategies would you be looking at specifically for upside potential?
Well, I like the reownership strategies, right? So coming in and buying, calls. Look at the time frame of when you want to make sales, right? And in that time frame, then you look at call spreads, which right now, especially after today, are fairly inexpensive. You can use this to help you feel better about making those sales, knowing that you haven't given up all of your upside potential. It's just a matter of where you want to put your risk. If you're using cash sales to manage your risk, and so that way you don't have to worry about buying puts or anything like that to the downside, and you can use paper that you're not paying a whole lot for to manage your opportunity, rather than using bushels to manage opportunity, which have a tremendous amount of downside risk, in my opinion.
Does anybody want to disagree, agree with that?
Well, I mean, I think right now, we're at basically, just this week you could have marketed soybeans 2019 for around 920. And you can do some window contracts, 920 puts against like 840 puts, so you have a window of opportunity to downside with an upside target of 1080. Those are numbers that you could do early in the week for about 18 cents, which that's a pretty wide window for everything that can go wrong. And remember, this year we could have a 900 million plus carryover. Next year, even with down 7 million acres, we probably still have a 500 million carry out without weather problems. So,
yeah, absolutely. It's not a bearish picture long term by any means. I want to bring it back to 2018 year, though. We also saw new highs posted in the November soybean contract earlier in the week. After Friday's close, where do you see us heading from here?
Again,
go ahead.
More into a short-term sideways pattern again, where with beans, 850 on the November contract is going to be a resistance area. Ultimately, the $8 mark would be the support, and I could just see us go back and forth in there for just a couple more weeks until we get into the next USDA report in October, and then who knows, with elections coming up in November, there's a lot of excitement that might miraculously happen or not happen in the coming weeks.
I think soybeans actually took this report fairly well. In my opinion, it was the soybeans had the most bearish report, but percentage-wise, soybeans weren't down nearly as much as corn was. Again, I think there's going to be quite a bit of optimism over the next couple of months that Argentina is going to come in and buy a lot of our soybeans and turn around and sell it to China and be that arbitrage for us. I think there's going to be a lot of optimism that there's going to be a deal that gets done sometime between now and the end of the year. So maybe that provides a window of opportunity for soybeans to rally a little bit. But as we were saying earlier, that window of opportunity needs to be taken to make some sales. So yeah, ideally soybeans can take 30, 40 cents higher sometime between now and the end of the year, but if they do, guys need to be looking at that for opportunities.
Darin, you look antsy.
Soybeans are going down. We rallied the soybean market because we dropped the NOVE contract down to where those who had hedges on could lift it because of the insurance price and the percent of the percent of insurance that they had on, which was in that 810 to 815 range. It's going to, so we got that buying out of the way. It's not there anymore. So now as we put more harvest pressure, if the rain ever moves out and we put more harvest pressure, possibly forced sales because of space in the soybean market, you're going to see basis continue to crash. You're going to see the future spreads continue to, the carry and the future spreads continue to strengthen. It's going to drive the market even lower. We're going to take out the $8 mark. We're going to go down. We're going to get into the
What's your downside target?
Well, back in early July, I said the technical target was down in the low 5s. That was on the cash side. We've seen some cash markets already go into 5. If you go up into the northern plains, it's already in the 5. It was already in the $5 range. Futures-wise, break through the 8. Going to use the old corn logic of big round numbers. Do I think it could get all the way down to 7? Probably not the NOVE contract, but I think we're just going to keep the market under pressure. There's no reason for it to rally.
Don?
Well, I think when you look at the soybeans, look at historical, and you got to be very careful this time of year. It's very dangerous. Usually we bottom the soybeans right around the 3rd, 4th, 5th of October. I would put a bet on that we do some kind of an intermediate low there again. I think the real question for the bean market, have we really lost world trade or not? And I'm not so sure we really have yet. Last month of September, China imported more soybeans than they did last year. So I think we have to see signs that they've actually slowed down first.
I want to continue this discussion as well. We've been having a lot of great discussions in the grain market. Let's transition, of course, to talk livestock. Let's start here with the live cattle market. Why are we trading at such a premium in the December contract for this time of year?
Yeah, normally it's about a $5 premium that the futures have to cash, and we're at an $8 premium, and it's because demand is so phenomenal. Our exports are up 19%. So if you want to talk about a happy export market that's solid, it's the beef market, and that's what's been pushing prices higher. The December contract has pretty big resistance at the 119 level, and that rightfully so, because there's plenty of supply out there. And thank God we have the export demand as strong as it is, and that we have consumer confidence as strong as it is, and the restaurant parking lots are full all the time. People are eating out. The deferreds have a friendlier story with slight production reduction coming on into first quarter, and as long as the exports can stay strong, I think you see the deferred contracts stay steady and work higher. I'm cautious about this December. I'm really watching this 119 level as resistance.
And Naomi, is that level sustainable?
I would say as long as our demand is strong, if we cannot clear the 119 hurdle, prices could meander back down to 114, 115, but ultimately with demand being so strong, I think we can hold firm.
Naomi, you mentioned strong demand, but then you say that the DEES premium is larger than usual to cash. Wouldn't it be just the opposite, that if we had strong demand for the cash product, that the cash should actually see a weaker, that the futures market should actually see a weaker premium? So what this is telling me is, it goes back to the argument, I think we've got some investment money looking for a place to go, and that's actually pushing it higher. We've got demand calculated into the cash market, but the reason the futures market's going up is because you've also, where's the investment money going to go? Yeah, it's going to go some over to the energy markets. I think it's also going into the livestock. We've still had big supplies of cattle. If we look at the cattle on feed every month, we're still running, 5-6% over last year. So it's not like we're running out of supplies. We have good demand. That's showing in the cash market. But the fact that the December continues to run so high, I think that's more of an investor move than an extra strong demand.
It absolutely could be, or we might see that cash market move higher.
Well, but then we're starting to talk about the could-be's again. But what we're talking about right now is the premium the futures have to the cash. And to me, that's not saying we've got this extraordinary move in the demand market that we're eating away at the supply. To me, it still makes the argument that we're having some troubles on the demand side, on the cash side, because the futures are running away.
Which is why we could see 119 fail as far as get through it, and then futures come back down.
Well, and again, that's why the premiums are out in December, is because they're expecting the cash market to strengthen throughout the month into December. So, I mean... But
that's also the lead month now, because October's getting ready,
Right.
So,
but
all the futures interest, all the futures interest now is off in the December.
Guys,
and in a combination of things, they're both right, because because it's strong consumer demand and it's huge fund buying.
Don, I'm going to ask you about feeders. Where are they headed from here?
Well, you know, the feeder cattle market is as good as the cash cattle market because it has to work on a crush standpoint. But feeders, I still think, have a nice bid underneath of them because of the cheap input costs. But I think when you have the feeders between 160, 155, 160, that's the upper end of the range just from a break-even standpoint. You can put a rate of gain on, or a pound of gain on for about 55, 60 cents. So I think that's a number that works.
Ted, really quick, hogs, are they going higher or lower?
We're running into some very stiff resistance here in the 200-day moving average, but we've been knocking on that door for quite some time, so we might get through. Overall, you know, hog demand, export demand really been quite good. Weights were a bit lower year over year. I think we could see a bit of a correction here, but longer term, I still think higher.
Okay. Thanks, guys. Thank you so much.
Thank you.
Thanks, Lane.
Thanks, Lane.
That wraps up the broadcast portion of Market to Market, but we will keep this conversation going on Market Plus, where we'll answer more of your questions. You can find it on our website at iptv.org/MTOM. Twitter was our first social media love. The 280 characters help us share links to our stories, photos, and questions for you several times a day. Give us a follow at Market to Market. Join us again next week when we'll explore how one nonprofit agency is feeding millions with food from overlooked sources. So until then, thanks for watching. I'm Delaney Howell. Have a great week.
Market to Market is a production of Iowa Public Television, which is solely responsible for its content. Pioneer Hybrid International is a proud sponsor of Market to Market. Tomorrow. For over 100 years, we've worked to help our customers be ready for tomorrow. Trust in tomorrow. Information is available from a Grinnell Mutual agent today.
AccuSteel, offering fabric-covered buildings specifically designed for the cattle industry since 2001. The next generation of cattle buildings. Information at accusteel.com.